Welcome, day traders. The US economy was proving to be stronger than expected, increasing the chance of achieving a soft landing, Japanese Deputy Finance Minister Masato Kanda told Reuters in an interview yesterday. He directly oversees the country's monetary policy and maintains close ties with the central bank governors. The strength of the US economy is underpinning the recovery of the global economy, including that of Japan, the diplomat said. At the same time, the policymaker refused to comment on the market's growing expectations that the Bank of Japan would abandon negative interest rates. Nevertheless, Kanda indirectly confirmed such a possibility, saying it was among important events that currency authorities were closely watching. Meanwhile, he acknowledged the fact that the Bank of Japan's ultra-loose monetary policy contributed to pulling Japan out of a state of deflation and reviving an economy. At the same time, Kanda spoke with a rare voice of caution by an incumbent policymaker over the cost of a prolonged monetary easing. Notably, Kanda was in charge of the yen-buying currency intervention in 2022, while the Bank of Japan kept its long-standing ultra-loose policy unchanged on Tuesday, and the regulator offered the clearest signal to date that an end to negative rates was approaching. For the Japanese yen, such prospects are seen as very distant. Today, its price against the US dollar is growing in the range of 147.30 and 147.90 on a more relevant factors such as a jump in yields on the US government bonds against the backdrop of yesterday's strong statistics from the United States. Despite this, the dollar-yen pair's movement during the Asian trading session was more of a consolidation. As the markets await the next batch of economic reports from the United States, the yen's downside potential will be limited. At the same time, it remains under bearish pressure, and the risk of a drop to the 147.00 and 146.40 support level cannot be ruled out. As for the yen's safe haven status, the Japanese currency's role in this regard has diminished significantly, as Masato Kanda acknowledged this fact yesterday. Investors are awaiting Friday's inflation data from Tokyo, and the price level is a leading indicator of nationwide price trends and should give the markets additional clues as to where interest rates are heading. Turning to global economic risks, Masato Kanda noted the worrying situation in the Chinese economy. According to him, deflationary pressures in the country are increasing, stagnation in the real estate market is growing, and domestic demand continues to decline. This poses a potential threat to the Japanese economy, which is heavily dependent on exports to China. Beijing promises to take measures to improve the situation. For example, late Wednesday night, the People's Bank of China announced that it would cut the required reserve ratio for banks by 50 basis points next month, and the move is expected to release about 1 trillion yuan of a long-term capital into the economy. However, the change will take effect after February 5th. Earlier this week, the Chinese government pledged to stabilize capital markets. To this end, the authorities intend to use about 2 trillion offshore yuan as a fund to buy domestic market shares. The additional liquidity from the ban should support economic activity and potentially ease financial conditions for investors. Meanwhile, investors in the United States assets are preparing for today's release of housing, unemployment, new orders, and most importantly, GDP and the price-deflated data. Statistics released yesterday showed that US economic activity accelerated more than expected in January. Both the services and manufacturing sectors expanded. As expected, the US dollar index rose to 103.20 from 102.80 after yesterday's robust data. And today in Asian trading, the US dollar is consolidating against its six major counterparts within a narrow sideways range of 103.20 and 103.40. Against this backdrop, the index may move towards the support at 103.10 and 102.60 or follow a bullish scenario and increase toward the technical resistance at 103.70 in the case of strong statistics. Notably, the US dollar index shows a general bullish momentum now. The strong dollar continues to put pressure on the antibody currencies, keeping rates well below yesterday's highs. The Aussie was also pressured by a dovish outlook for the country's Reserve Bank policy. And today, the Australian regulator indicated that a slowdown in price growth is expected over the next 6 months. The Aussie's retreat against the greenback was due to the hawkish comments from the US Federal Reserve. In addition, the Aussie ignored positive news from China and the growth of commodity assets today. The Australian currency spanned the Asian session, consolidating in the range of 0.6560 and 0.6590. The next support and resistance levels are located at 0.6530 and 0.6610 respectively. Following its Australian counterpart, the New Zealand dollar has been trading at a very moderate pace, despite rising risk sentiment in the global equity markets and other optimistic factors for the antibody currency. For example, a quarterly report released yesterday showed that New Zealand consumer prices remain well above the Reserve Bank of New Zealand's target. In the best-case scenario, this would have supported the Kiwi, as it limited the likelihood of an imminent interest rate cut. However, as we have seen many times before, external factors are much more important for the Australian and the New Zealand currencies than domestic ones. As a result, the Kiwi has been trading in a narrow range of 0.6100 and 0.6120 today, maintaining bearish momentum. If the US data is strong, the Kiwi dollar pair will drop lower with the risk of breaching important support at 0.61. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below and see you online soon.